Structural hedges in financial risk management. Exploring hedging techniques for financial stability. Agenda items. Introduction to structural hedges. Components of a structural hedge. Types of structural hedges. Implementation and strategies. Benefits and challenges. Introduction to structural hedges. Understanding structural hedges. Structural hedges are strategies that align financial instruments with economic exposures, aiming to mitigate risk effectively. Purpose of hedges. These hedges protect organizations from adverse market movements, safeguarding their financial stability. Purpose and importance in financial risk management. Shared in financial performance. Structural hedges are designed to protect a company's financial performance from unpredictable market fluctuations and risks. Volatility management. By utilizing hedging strategies, companies can manage volatility in market prices, interest rates, and currency exchange rates effectively. Stability and predictability. Hedging ensures stability and predictability in financial outcomes, which is crucial for long term business planning and investment. Common uses in various industries. Manufacturing sector. In manufacturing, structural hedges help manage risks related to commodity prices, ensuring cost stability and operational efficiency. Finance sector. Within finance, structural hedges are crucial for managing risks related to interest rates and currency fluctuations, safeguarding investments. Energy sector. The energy sector utilizes structural hedges to stabilize revenue against volatile energy prices, ensuring financial resilience. Key financial instruments involved. Options. Options provide the right but not the obligation to buy or sell an asset at a predetermined price, helping manage price volatility. Futures. Futures contracts are agreements to buy or sell an asset at a future date, aiding in price certainty and risk management. Swaps. Swaps involve exchanging cash flows between parties, commonly used to manage interest rates and currency risks. Forwards. Forwards are customized contracts allowing parties to buy or sell an asset at a set price in the future, useful for hedging. Role of derivatives in structural hedging. Importance of derivatives. Derivatives play a crucial role in structural hedging by offering leverage to manage financial risks effectively. Customization for exposures. Derivatives can be tailored to meet specific risk exposures, providing flexibility in financial strategies. Locking in prices. Using derivatives enables organizations to lock in prices or rates, reducing uncertainty in financial planning. Underlying assets and their management. Importance of asset management. Effective management of underlying assets is crucial for successful hedging and risk mitigation in financial markets. Understanding asset characteristics. Understanding the characteristics of underlying assets helps in creating tailored hedging strategies that match risk exposure. Hedging strategies. Determining appropriate hedging strategies is essential to align with specific risk exposures and market conditions. Types of structural hedges. Natural hedges. Definition of natural hedges. Natural hedges refer to situations where a company's cash flows are naturally offsetting, reducing financial risks. Matching revenues and expenses. When revenues and expenses are matched in the same currency, companies can minimize exchange rate risks. Reduction in hedging needs. Natural hedges reduce the need for formal hedging strategies, simplifying financial management. Transactional hedges, risk management and transactions. Transactional hedges are essential for managing risks tied to specific transactions, particularly in international trade. Use of forward contracts. Forward contracts are commonly used in transactional hedges to lock in prices and mitigate risks in future transactions. Options in hedging. Options provide flexibility in transactional hedges, allowing businesses to manage price fluctuations effectively. Operational hedges. Risk reduction strategies. Operational hedges are strategies that businesses implement to reduce exposure to various risks, ensuring stability. Supply chain diversification. Diversifying supply chains is a key operational hedge that helps mitigate risks associated with dependency on single sources. Mitigating price volatility. Sourcing materials from various suppliers helps businesses manage and mitigate price volatility in the market. Steps to design a structural hedge. Understanding risk exposures. Identifying and analyzing risk exposures is crucial in the design of an effective structural hedge. Setting clear objectives. Clearly defined objectives guides the selection of tools and strategies in designing a structural hedge. Selecting appropriate instruments. Choosing the right financial instruments is essential to effectively mitigate risks in the hedging strategy. Effective implementation techniques. Continuous market monitoring. It's essential to continuously monitor market conditions to identify trends that may impact the hedge's performance. Regular evaluations. Regular evaluations of the hedge's effectiveness help ensure it remains aligned with market dynamics and organizational goals. Adjustments for optimization. Making necessary adjustments to the hedge can optimize performance and mitigate risks associated with market fluctuations. Monitoring and adjusting strategies. Importance of monitoring. Regularly monitoring the performance of structural hedges ensures their continued effectiveness in mitigating risks. Adapting to market changes. Timely adjustments to strategies are essential due to changes in market conditions and risk exposure. Risk exposure management. Understanding shifts in underlying risk exposures allows for informed adjustments to hedging strategies. Advantages of employing structural hedges. Financial stability. Structural hedges provide greater financial stability by mitigating risks associated with market fluctuations. Predictability of cash flows. Enhanced predictability of cash flows is achieved, allowing businesses to plan and allocate resources effectively. Improved decision making. With reduced risk exposure, organizations can make better informed decisions, leading to more strategic outcomes. Potential risks and drawbacks. Basis risk. Basis risk arises when the hedge does not move in correlation with the underlying assets, potentially leading to losses. Liquidity risk. Liquidity risk occurs when there are insufficient funds to execute a hedge, which can impact financial stability. Complexity of strategies. The complexity of hedging strategies can lead to unintended consequences if not managed effectively, increasing the risk of errors. Conclusion. Importance of structural hedges. Structural hedges are crucial for managing financial risks and ensuring the stability of organizations in volatile markets. Components of hedges. Understanding the components of structural hedges helps organizations develop effective risk mitigation strategies tailored to their needs. Implementation strategies. Effective implementation strategies for structural hedges are essential for achieving desired financial outcomes and stability. Thank you.